Silver paper contracts are trading at $71 an ounce right now, but in Tokyo and Dubai, physical bars are moving at $130. That's an 80% premium that shouldn't exist in a functional market. CME hiked margins by 50% overnight last week, triggering forced liquidations that dumped prices 10% in minutes. Yet backwardation hasn't resolved. Futures remain below spot, and inventories have plunged 70% since 2020. This isn't volatility. This is the paper system fracturing under its own leverage, with 378 paper claims for every physical ounce in vaults. The kill switch banks pulled to suppress the surge just accelerated the disconnect, and now the real metal is pricing itself independently. Look at the flows. Industrial users aren't waiting for futures to catch up. They're pulling physical silver out of the system at any cost because production lines can't stop. Solar panels, EVs, semiconductors. Silver consumption is up 3.4% compound annually, outpacing mine output that's 70% tied to base metals and gold byproducts. China just announced no silver exports past January 1st, 2026, locking down their stockpiles while quietly forming buying groups to raid U.S. physical holdings from weak hands. That's not speculation. That's a sovereign move to secure inputs when global supply chains feel conditional. And here's the signal. Bullion banks have stopped lending silver to each other. The interbank metal market is frozen. In a stable setup, leasing smooths everything. Banks borrow, short paper, roll over. Now, refusal to lend means no more illusion of abundance. The system's nervous system is seizing, and it's happening live. This break didn't start with the margin hike. It started when the paper-to-physical ratio hit 350 to 1 earlier in 2025, and demand flipped the script. Remember how silver surged 158% last year, touching $84 before the emergency weekend call at $80? Institutions scrambled because their shorts were underwater, but instead of covering, they changed rules mid-game. CME's technical glitch in November nuked spot $1 in minutes during a breakout attempt. Coincidence? No, that's plumbing failing intentionally to cap price. But physical didn't follow. Spot held while futures tanked. Spreads widened to $5 between East and West. Arbitrage should close that, but it hasn't, because paper demands aren't pulling real metal anymore. The market is decoupling, and that's the fracture point, where leverage that once suppressed now amplifies the snapback. If you've tracked silver flows or work in commodities, tell me in the comments how this disconnect looks from your end. Does it match what you're seeing in delivery queues or premium bids? Pull back to history for a mirror. In 1980, the Hunt brothers tried to corner silver with paper leverage, pushing it to $50 before COMEX changed rules overnight. Hiked margins, limited positions, forced liquidation. Price crashed 50% in days. Banks won because the rally was debt-fueled, not physical-driven. Fast forward to now. It's inverted. Physical demand is the driver, not leverage games. Miners produce 830 million ounces annually, but paper trades a billion daily. 240 billion ounces a year in derivatives against real output that's shrinking from geopolitical curbs like China's export ban. That 1980 kill switch worked because the system was paper dominant. Today, it's failing because industrial pull is existential. EVs alone need silver for conductivity that no substitute matches, and with supply chain to copper and lead mines facing their own bottlenecks, the math breaks. Earlier mechanics relied on endless leasing to flood paper supply. Now, with no interbank lending, that valve is shut. The loss of stability? Right there, in the transition from paper control to physical pricing. Interweave the geopolitics, because silver isn't just industrial, it's strategic. Military applications eat into supply. Missiles, radar, even nuclear tech use silver for unmatched conductivity under extreme conditions. When China bans exports, it's not about trade. It's about securing advantage in a world where logistics turn weaponized. Shipping silver bars transatlantic on cargo flights to capture Shanghai premiums? That's not routine commerce. That's desperation arbitrage, exposing how Western vaults are draining eastward. U.S. enforcement can't touch that flow directly, but watch how it echoes. Higher physical prices force refineries to reconfigure, margins compress, and downstream costs spike in everything from solar farms to defense contracts. The system's assumption was predictable access. Mine, refine, deliver without friction. Remove that, and you don't need a blockade. Market self-enforced scarcity. This is where the break deepens. Global alignments shift because silver's movement feels conditional on who controls the choke points. The margin hike last week was supposed to be the reset. Curb speculation, protect the clearinghouse, stabilize. Instead, it backfired. Rumors of margin call stress at HSBC and UBS circulated immediately, with a major bank reportedly blowing up its futures position at 2 a.m., missing a call that triggered $34 billion in emergency Fed injections, plus forced liquidation algorithms. That's not containment. That's panic bleeding into the open. Paper prices dumped 10%, but physical premiums in Asia held at 80%, some spots hitting $60 over spot. Why? Because the kill switch exposed the naked shorts. Banks holding massive derivatives without hedges, betting on suppression that no longer works. The CME's 50% margin increase was procedural warfare, deniable, but it injected uncertainty that made participation irrational for anyone not locked in. Traders paused contracts, ships rerouted metal, insurers flinched on coverage. Time became the multiplier. Idled cargoes bleed costs at scales that turn maybe into no. This is modern commodity pressure, quiet, self-reinforcing, and now rebounding on the enforcers. For those in finance or trading desks, if you've seen similar rule changes trigger unintended squeezes before, share your take in the comments. What makes this one different in execution or fallout? The deeper layer is the shockwave outward. Every ounce that doesn't move from vaults is an ounce not arriving at refineries configured for it. Chinese planners aren't casual. Their solar dominance depends on uninterrupted silver throughput. When Western banks pull the switch, it doesn't stop at COMEX. It signals to Beijing that supply is reachable, vulnerable. But China's response isn't symmetric. They don't fight on paper. They stockpile, ban exports, and let physical repricing do the work. This flips the leverage. US banks, overextended on shorts, now face solvency risks as physical pulls paper upward. The 378-to-1 ratio? That's hundreds of claims per ounce finally being called, threatening bullion banks' balance sheets. Enforcement costs mount, patrols on compliance, legal follow-through, all feeding deficits. Those deficits land in capital markets, where confidence is the real currency. Compare this to the 2011 spike. Silver hit $49 on backwardation, but paper mechanisms reasserted control through margin hikes and position limits. The system held because industrial demand was lower, and leasing pools were deep. Now, demand outpaces supply structurally, with EVS and green tech compounding. Geopolitics layers on. Russia's silver tied to base metals facing sanctions friction, Middle East logistics strained by canal risks. The old mechanics worked when uncertainty was low. Today, it's embedded. Where does stability erode? In the feedback loop. Banks suppress to cover shorts, but suppression widens the physical paper gap, forcing more aggressive hikes that accelerate the decoupling. It's not growth, it's rupture. The market isn't behaving like a neutral arena anymore. It's a battlefield where physical scarcity imposes costs faster than paper can absorb. If you're in the industrial sector or follow supply chains, drop your observations in the comments on how these export bans and premiums are hitting real operations. Does it feel like a temporary snag or a permanent shift? Logistics amplifies everything. Silver doesn't move on ideology, it moves on insurance, port access, banking clearance. When banks freeze lending, it's not just a signal, it's operational paralysis. Ships avoid routes before risks materialize. Contracts get reevaluated mid-voyage. In October 2025, we saw it. $8 premium in Shanghai over COMEX. Traders booking cargo flights to arbitrage. That's not efficiency. That's the system compensating for breakdown. And it cascades. Refineries slow, margins tighten, end users pay up or substitute. But silver's properties make substitution a loss. Military spheres feel it too. Silver in guidance systems, batteries, coatings. Disrupt that, and defense planning shifts from abundance to rationing. The US can project rules through CME, but China counters by making physical the anchor. This is the inversion. What was a regional commodity play becomes global realignment, with silver as the lever. The kill switch failure is evident in the persistence. After the hike, volatility didn't curb. It intensified. Paper crashed, physical held, spreads widened. That's the market refusing compliance. Banks intended to make speculation expensive. Instead, they made holding paper irrational. ETFs like SLV and CVR saw inflows, but now face credibility hits. If NAV lags physical by $60, redemptions loom, and retail can't easily claim metal. That's the trap. Paper promises abundance, but delivery exposes scarcity. Historical crises show this pattern. 2008 gold decoupling started small, with premiums creeping before exploding. Silver is now at that threshold, where paper no longer dictates. The loss of control? In the migration from futures discovery to physical benchmarks. Once that flips, repricing isn't gradual, it's violent. For anyone who's lived through past commodity squeezes, Interpret this in the comments. Does the current backwardation remind you of 2011? Or is it signaling something larger, like a full repricing event? Weave in the military angle, because silver's dual use blurs lines. It's not just panels and circuits. It's stealth tech, EMP shielding, even hypersonic components. When supply feels conditional, nations don't debate. They adapt. China's ban isn't isolation. It's preparation, pulling silver into sovereign vaults while Western banks bleed on shorts. Logistics turns geopolitical. Malacca Strait for Asian flows, Suez for Europe, choke points where friction multiplies costs. Banks' overnight rule change was meant to contain. It signaled reach, but also cost. Enforcement isn't free. Margin calls, injections, all accumulate on sheets already strained by 2025's surge. The $34 billion Fed repo? That's not routine. That's propping a fracture. Deficits widen, borrowing spikes, confidence erodes. This is the core tension, using paper dominance to suppress expose's financial fragility. The narrative inverts here. Banks launched the kill switch, thinking it would reset to normal. But normal was the illusion. With inventories down 70% and physical demand structural, the hike just hastened the physicalization event. Naked shorts get called, solvency whispers turn to rumors. HSBC, UBS under stress. The system's designed for predictability. Inject this uncertainty, and it self-destructs. Traders cancel before penalties, insurers price out, and suddenly participation is the risk. Venezuela's oil squeeze in the material mirrors this. Pressure on flows to hit a rival, but it boomerangs into systemic costs. Silver's version. Banks squeeze paper to protect positions, but it forces industrial buyers to physical, draining vaults faster. Where stability cracks. In the asymmetry, physical can't be printed, but paper claims can multiply until they snap. If you've got experience with derivatives or margin mechanics, weigh in below. How do you see these forced liquidations playing out if physical keeps diverging? Margin spiral or full unwind? Pull the threads together. This isn't about silver alone. It's the commodity system losing its anchors. Geopolitics interlaces. China's groups eyeing U.S. physical, while banning export signals a grab before lockdown. Industrial pull from green transitions compounds with military stockpiling, turning logistics into leverage. Banks' overnight change, hiking margins, tweaking rules, was the procedural blade, but it cut both ways. Paper volatility spikes, but physical steadies at premiums that scream scarcity. Historical parallels like 1980 show suppression works when demand is elastic. Now, it's inelastic, existential. The break is in that shift, from controllable paper floods to unyielding physical drains. Enforcement costs, repos, bail-ins, feed back into deficits, making the next hike even costlier. The market's reacting as designed, but the design assumed endless compliance. Now, refusal is the norm. The phase we're in is the decoupling's acceleration. Paper will chase physical upward, not the reverse, as claims get tested against vaults. No explosion yet, but the pressure builds methodically, transaction by transaction, until the repricing lands. Banks messed up by assuming control. Reality's logic dictates otherwise, cold and unrelenting. If this analysis resonates with your market view or contradicts it based on data you've seen, lay out your interpretation in the comments. Collective signals sharpen the picture. The fracture isn't healing, it's propagating. As of January 4th, 2026, physical silver in London vaults sits at 87 million ounces, down another 4 million since mid-December when the margin shock hit. That's a 32% drop in just 6 weeks. Meanwhile, Shanghai Futures Exchange registered silver stocks climbed to 1,240 tons, up 18% in the same window, as Asian refiners and sovereign entities quietly vacuumed up every available bar that could be rerouted. The arbitrage spread between COMEX and Shanghai has stabilized not at zero, but at a new floor. $28 to $32 per ounce consistently since New Year's. That isn't convergence. That is bifurcation. 2 markets, 2 prices, 1 metal. The paper system did not absorb the physical demand. It splintered off, and the break is now structural. Watch what the institutions are actually doing, not what the headlines say they should do. JP Morgan, still the largest COMEX short, increased its net short position by another 8,200 contracts in the latest CFTC report, equivalent to roughly 41 million ounces added to the paper overhang. Right as physical delivery notices spiked 140% week over week. That's not hedging. That's doubling down on a losing bet, while the vault doors stay open to Asia. HSBC and Scotia, the other big clearing members, reported elevated delivery fails in December. Bars allocated, but not handed over, because the chain of custody paperwork suddenly required extra layers of compliance scrutiny. Translation: banks are stalling physical outflows to buy time for their paper books. But time is no longer neutral. Every day of delay widens the premium. Every failed delivery feeds rumors of insolvency stress. And every rumor pulls more physical bids from end users who can no longer trust paper promises. This is where the kill switch logic inverts completely. The overnight margin increase and the emergency position limit whispers were designed to force speculators out, protect the clearinghouse, and restore order. Instead, they forced the only participants left, industrial consumers and strategic accumulators, to go full physical. Solar module manufacturers in Jiangsu are now bidding 90 to 110% over spot for immediate delivery, not because they love paying premiums, but because a single production halt costs more in fixed overhead than the entire quarterly silver budget. Tesla's Shanghai Gigafactory reportedly shifted to spot market purchases for its battery contacts after a 3-week delay on contracted futures deliveries. When the largest EV producer on Earth starts treating futures as unreliable, the paper market loses its discovery role. Price no longer forms in Chicago or New York. It forms in factory loading docks and bonded warehouses in Pudong. If you're inside manufacturing, procurement, or refinery ops in Asia or Europe right now, describe in the comments what delivery timelines and premium levels look like on your contracts. Has the paper hedge become a liability instead of protection? The numbers keep compounding the fracture. Global mine supply for 2025 closed at approximately 824 million ounces, down 1.2% year over year, mostly from Peruvian and Mexican disruptions tied to permitting and community blockades. Recycling added another 180 million, but industrial offtake hit 712 million ounces, a record 7% jump driven by photovoltaics, up 14%, automotive electrification, up 22%, and 5G electronics, up 9%. That leaves a structural deficit of roughly 108 million ounces before investment demand is even counted. Yet COMEX-eligible inventories sit at 112 million ounces, barely enough to cover 1 month of global industrial consumption if flows stop tomorrow. The system was never built to handle a sustained physical drain at this velocity. It was built assuming paper could always dilute reality. When reality refused to dilute, the dilution mechanism itself became the bottleneck. Geopolitics is no longer a background variable, it's the accelerator. China's Ministry of Commerce didn't just extend the silver export suspension past January 1st. They layered it with new National Strategic Reserve classification language for certain high-purity grades, 99.99% plus. That isn't trade policy. That's declaring silver a dual-use material under wartime footing, similar to how rare earths were handled in 2010. At the same time, Indian customs data shows a 240% surge in silver imports via air cargo in Q4 2025. Small bars, high value, fast movement. Exactly the profile used when sea routes feel too exposed or too slow. These aren't retail jewelry buys. These are central bank adjacent entities and private treasuries front-running the squeeze. When sovereign-grade players behave like that, the assumption of predictable global flows collapses. Logistics stops being commerce. It becomes contested terrain. Here's the cold arithmetic that breaks the old model. At current consumption rates, every 100 million ounces pulled east reduces Western vault depth by roughly 12 to 15%. At that velocity, LBMA, good delivery lists, start thinning in months, not years. Once a major clearer drops below minimum vaulting thresholds, clearing members face regulatory capital charges under Basel III that make holding short silver positions punitive. That is not a hypothetical. It's math. JPM's reported 2025 silver derivatives notional already exceeds $120 billion. Leverage that was viable at $30 to $40 silver becomes balance sheet cancer at $70 to $90 physical benchmarks. The margin hike was supposed to protect against that cancer spreading. Instead, it diagnosed it in public. If you follow CFTC positioning, Bank 13F filings, or vault flow reports, tell me in the comments which clearing member you think cracks first under sustained delivery pressure, JPM, HSBC, or someone quieter, and why the data points that way. The self-reinforcing loop is now visible in real time. Physical premiums rise. Industrial users accelerate spot buying to avoid production risk. Vaults drain faster. Paper shorts face higher, mark-to-market losses. Banks demand more margin or force liquidations. Forced sales push paper prices down, temporarily. That dip attracts fresh physical bids because the real metal is still scarce. Premiums rise again. Each cycle strips another layer of illusion from the paper system. The December 2025 technical adjustment at CME, when bid-ask spreads blew out to $4 during the $80 rejection, was not a glitch. It was the exchange's matching engine choking on unbalanced order flow. Too many buyers, not enough willing sellers at any price that keeps shorts solvent. When the machine itself hesitates, confidence in centralized discovery evaporates. Military consumption adds the final unquantifiable pressure. DoD silver use is classified, but public contract awards show a 38% year-over-year increase in procurement for specialty conductors and high-reliability interconnects in fiscal year 2025. Hypersonics, directed energy systems, satellite hardening, all require silver in quantities that scale poorly with substitution. When a government that prints the world's reserve currency starts competing with its own industrial base for physical ounces, the contradiction becomes existential. You cannot simultaneously suppress silver to protect paper books and stockpile it for strategic deterrence. One imperative must yield. Right now, the suppression imperative is losing. The phase transition is measurable. In October 2025, 68% of global silver price discovery still occurred on COMEX. By late December, Bloomberg terminal data showed that share dropping to 41%, with the balance shifting to Shanghai, spot OTC in Hong Kong, Dubai, and private dealer quotes. Once paper loses majority discovery, it loses pricing authority. Futures become followers, not leaders. Backwardation that once lasted hours now persists for weeks. The January 2026 front-month contract is trading $4.80 under spot as I record this. Levels last seen in genuine supply crisis mode, not in managed paper markets. This is not a bull run. This is the architecture of price formation changing hands. For anyone trading physical metal or managing commodity risk books, share below. If you've seen the same migration in settlement currency or delivery location preferences, has RMB denominated or gold swapped silver become the new benchmark hedge? The bank's miscalculation was assuming the physical market would eventually bend back to paper logic. It won't. Every forced liquidation in futures removes a layer of artificial supply. Every premium paid in Asia removes a bar from Western custody. Every export ban from a major producer removes future output from the global pool. The system is not correcting. It is bifurcating into a high-priced physical reality and a lower-priced paper shadow that increasingly fails to redeem. The kill switch did not contain the surge. It lit the fuse under the leverage pile that had been accumulating since the 2016 bottom. What comes next is not orderly mean reversion. It is disorderly revaluation. Shorts will cover, not because they want to, but because solvency demands it. Vaults will empty, not because demand is temporary, but because demand has gone structural and geopolitical. Paper will chase physical upward until the last naked claim is either covered or defaulted. And when that happens, the damage won't be contained to silver traders. It will ripple into every downstream product that assumed cheap conductivity was permanent. Solar LCOE calculations, EV battery margins, 5G rollout economics, defense procurement budgets. The shock is no longer prospective. It is embedded. This is the phase where control is visibly lost. Not with fanfare, not with announcements, but with silence where liquidity used to be. With premiums that refuse to collapse. With vaults that keep trending toward zero, while futures pretend abundance still exists. The banks pulled the switch to preserve the illusion. Reality pulled harder. And now the system is learning, the hard way, that physical scarcity does not negotiate. If the divergence between paper and physical keeps widening in your corner of the market, lay out what you're seeing in the comments. The collective picture is forming whether the headlines catch up or not.